Hello everyone, PS from PS Invest Plays here today. The outlook for the global energy complex continues to improve significantly from the worst of 2020. Demand for refined petroleum products such as gas, diesel, and petrochemical products continues to recover. In its second quarter earnings report, Chevron provided a peek at the kind of upside this recovery could bring to exceptionally managed energy companies. Chevron is a stellar dividend growth opportunity whose stock price has risen 16% in 2021. Is this trend going to continue, or we can expect either a pullback or sideways movement going into 2021 and beyond? In this video, we will understand its business, its financials, its future outlook, and review its charts using Elliot wave theory to see how we can make money. So stick around. I think you'll like what I have in store for you today. Chevron Corporation, ticker CVX. Chevron Corporation is an American multinational energy corporation. It was founded in 1984 and it is the third largest oil company in America. It is headquartered in San Ramon, California, and active in more than 180 countries. Chevron is involved in most aspects of the oil and gas industry. To manage these vast and complex operations, the company is divided into three main segments. Upstream includes exploring for, developing, and producing crude oil and natural gas. Additionally, this segment includes the company's extensive operations around liquefied natural gas. Lastly, this segment includes some of the transporting, storage, and marketing for both oil and gas. Downstream consists primarily of refining crude oil and marketing of both crude oil and refined products. Additionally, this segment also handles some of the company's transportation for crude oil and refined products. All other. This segment includes the company's global cash management and financing activities, administrative functions, insurance, and real estate. It also includes Chevron's technology companies. With its vast and diverse business, it is no wonder that investors in Chevron benefited from a nearly 60% return from the end of 2015 through 2019. The period started with a major challenge for oil and gas companies as the price of oil collapsed at the beginning of 2016. Fortunately, since the company had a strong balance sheet and a well-diversified business, Chevron was able to navigate through this rough patch better than most of its peers. Impressively, Chevron has been able to grow both the revenues and operating income since the first quarter of 2016. This speaks volumes about the management team's ability to make the right decisions under immense pressure that will benefit shareholders in the long run. Additionally, these changes have made Chevron more efficient and capable of operating at fairly low price levels for oil. I think around $30 or $40 per barrel. Generally, Chevron's vast operations have supported strong growth for the company while also minimizing the impact of short-term challenges in the energy sector. Similar to other energy players, Chevron's business model was not enough to manage the early phase of 2020 without making major changes. This resulted in three big adjustments to the company's business. Number one was capital expenditures. Chevron reduced their capital and exploratory budgets through 2025. In 2021 alone, the budget has been cut to $14 billion and will be $14 billion to $16 billion through 2025. This change is based on a prioritization and ranking of each project by its expected return on investment. Operating expenses. Management scrutinized the operating expenses in great detail for areas to reduce overhead costs. Shareholder distributions. Management opted to suspend the company's share repurchase program. This action was taken to further bolster capital for the company. Fortunately, for income-oriented investors, they only opted to suspend growth of the company's dividend and not cut dividend distributions. The result of these decisive actions has positioned Chevron well versus with its peers. As oil prices have risen since 2020, I expect this positioning to help Chevron outperform its peers. It offers steady stream of dividend income. In addition to Chevron's strong margins, the focus on the dividend is also important. During early 2020, management has been in strong support of the current dividend levels despite the collapse of oil prices. This is not terribly surprising as Chevron has been a popular holding amongst dividend-focused investors for decades. During financial crisis of 2008 and 2009, due to Federal Reserve's actions to bolster the economy, the interest rates fell to historically low levels. Today, we are seeing even lower interest rates than in the financial crisis. And given the impact of 2020, these rates are expected to remain low for years. Due to these lower rates, income-oriented investors shift to invest in high-quality dividend stocks to replace lost income. Looking at the overall future of fossil fuels, according to the presentation given at the Barclays Energy Conference, the global energy demand will rise by 20% by 2040. And gas and oil will continue to be some of the largest sources of energy. While supply and demand for oil are estimated by US Energy Information Administration to reach equilibrium in 2021, any surprises to the demand side could drive oil prices notably higher. Considering that oil is currently above $70 per barrel, as the world is in the middle of returning to normalcy, there is still room to run from here. Looking at the financials, for Chevron, revenue, gross profit, EBITDA, net income, earnings per share, EPS are extremely good for Chevron Corporation. Chevron dividend for its common shares now stands at $1.34 per share quarterly, or $5.36 per year. At its current price, that amounts to a cash return of 5.7%, which is higher than the average dividend yield for the S&P 500, which is 1.3%. And Chevron has been paying dividends since 1962 and is also increasing them yearly. It did not cut its dividend in 2020, which is remarkable. Currently, Chevron is trading just above 1.5x book value per share, which is at the low end of its historical range. Considering that Chevron is poised for record profit margins and strong cash flows due to the factors we discussed today, and also increase in oil prices, Chevron stock should be trading at or above the historical book value of 1.8x. This is also indicative in the charts where I see the stock price to increase considerably in the next 3 to 5 years. Now let's look at the charts for Chevron. If you like this video, please don't forget to subscribe, hit the like button, and hit the notification bell icon so you're notified when I upload a new video. The bull wave that started for Chevron way back in 1970s is still not over. It has completed its first 3 supercycle waves and currently it is in its strongest supercycle wave, which is wave 3. If we look deeper in this wave 3, we can see that the first 2 waves are over and again Chevron is in its wave 3 of the primary cycle, which means it is in its strongest bull wave. Wave 3 is typically a 261 3.8% extension of waves 1 and 2, which means a price target of $200.26. At this price point, I expect a 23.6% retracement or a pullback in Chevron's stock price, bringing the stock price down to around $168. After this pullback is completed, I expect wave 5 to resume, taking the stock price to $261.82, which means a profit of 168% in the next 4 to 6 years. Now, let's summarize. The current stock price for Chevron is an excellent entry point. I would recommend long-term investors to nibble at current prices, and if you see any further weakness in the stock price, accumulate heavy and hold it for the long term, at least for 3 to 6 years, to see a 168% profit in the stock price. And the icing on the cake is that Chevron pays 5.7% dividend yield. What do you think of this analysis? Please leave me a comment and let me know. As always, don't forget to subscribe, hit the like button, and hit the notification bell icon so you're notified when I upload a new video. Until then, bye-bye.